Hi, everyone. My name's Laura Ebenstein, and I work out of the HUCTW office. We are thrilled to be able to offer the debt repayment strategies seminar today with the credit union, and we're thrilled to have this collaboration going on to tackle different issues that are affecting our membership for a variety of reasons. With that said, I'm going to pass this off to Dominique, who's going to start the presentation. So thanks so much, Dominique.
All right, thank you so much, Laura, and thank you everyone for joining us here today. Today we're going to get started, and just some household rules just before we get started. So your background noise is muted, so it's okay if the dog is barking or the baby's crying in the background. And also, we're going to be using the questions feature, and you can submit all of your questions. Actually, we can test it right now. Let's see if it's working. Okay. So you can submit your questions in the questions feature, like I said. And also, this presentation is being recorded. So if you need to rewatch it, you can watch it on our YouTube channel at My HUECU. And I'm the community engagement specialist. By my side today is my colleague, Migdalia Gomez. She is AVP of Community Engagement, and she'll be doing the latter part of this presentation. So I wanted to give you a quick little brief overview about the difference between the credit union. So the credit union basically started with a group of guys who couldn't get loans anywhere. And they decided, you know what, we'll put our heads together and we'll loan each other money, give each other an opportunity to give that money back at a better rate so that we can all save. So the credit union really exists for the sole purpose of members. It's really an opportunity to save the members money, just provide better loans, fees, and different services and perks. And we just have a different business model as opposed to a bank. And we really try to be involved in the community and somehow. So, what are your goals? I mean, the year is pretty much almost over, but we all have goals. I know I have one. Um, I am trying to save for a new car because my other car it's on its last leg, but it's still ticking away. But what are some of your goals? You can write it down. You don't have to share with the group. What are some of your goals? So we'll use those goals throughout the presentation. So the reason I ask, what are your goals? We use a organization called Green Path. It's a free service that we pay for. And when you basically see it on paper, what your goals are, and you align all of your priorities and you see, okay, this is what I'm working towards, this is what I need to do to achieve those goals, it makes it a little bit crystal clear to you because when you just kind of think about it, it's sort of still not as real. So when you have it down in paper, you can go back to your notebook or your journal and you can say, okay, these are some of the goals that I'm working towards. These are some of the things that I need to do, the steps I need to take in order to get to that goal. And like I said, for me, it's trying to get a new car. But so I need to write down some of the things I need to do and strategies I need to get to in order for me to achieve that goal. So do is look at how much do you owe? How much do you owe? Do you owe a lot in your credit cards, student loans, and other any kind of credit that you have? So you want to know, you write it down, and you want to know, okay, what's your credit score? Is it something you can work on? You need to work on? That's okay because it's a work in progress. We're all on this journey together. You also want to calculate a cost of debt, like how much overall that you have in terms of your debt, and how are we going to go about attacking that debt and making sure that we can achieve some of the goals that you guys just wrote down. So, for example, this is like a quick little scenario about goals in terms of how much you owe, right? For example, if you owe $10,000, and the interest rate is 7.5, it's going to take you 120 months to pay it if you're paying 119 a month. And then this is the you're going to pay all the interest rate that you're going to pay. And then if you owe $5,000 and the interest rate is 18%, it's going to take 60 months. So 60 months is about what, 5 years? If you pay $127 a month, the interest rate you'll pay overall is over $2,000. So when you see it on paper and you see it written down, then you kind of can figure out, okay, I have this amount of time to pay this off, and this is what I'm going to do to achieve that. For example, you have the total of payment of $15,000 that you need to pay back. You pay it at $246. Again, you can pay a little bit more if you're able to afford that. You end up paying an interest rate of over $6,000. So when you have it written down, it's a little bit more crystal clear, and then you can kind of figure out, okay, what do I need to pay off first in order to achieve those goals. So the first step you want to do is you want to try to figure out, okay, let me see what strategy should I use in order to reach that. So there are two different methods that we can use. So the first one is a snowball effect, which basically you focus on the small amount of debt. You can make minimum payments each month, and you make extra payments on that small loan or small credit card debt, and then you pay it off and you move on to the next thing. If you're one of those people who pretty much like to kind of cross things off your list, I'm one of those people, like, okay, let me get this task done, cross it off my list. I know I'm done with it. I can move on to the next thing. The next one is the Avalanche method. So you kind of focus on the one that has maybe the highest interest rate, and then you kind of go about it that way. You can make the minimum payments on each debt every month, and any kind of extra money you may have, you pay that extra, the highest interest rate loan off. And when you pay it off, you move on to the next one, and you start chipping away at that one. And for some people, if they don't mind having a lot of things on their list, they want to wait a little bit longer to just kind of pay some debt, that's another way to use it. And some people use the Avalanche method also kind of to save, it saves them money because they're paying off the higher interest rate first as opposed to the lowest amount. Because the lowest amount could be one that, say, for example, you owe $5,000 on that lowest one, but if the interest rate is like maybe 5% or 7%, which is not realistic, but just to using it as an example, and you're paying it off first, you could be paying off the highest interest rate off first. That ends up saving you money. So this is another example of the snowball effect. So you can start here, focus on that small debt, and then you can kind of chip away at it that way. Okay, I'm done with this. Let me go on to the next thing. I'm done with this one. Let me move on to the next thing. Whereas the Avalanche method, you want to focus on the highest interest rate. And a lot of credit cards, especially with the interest rate going up, which is not something that we like, but we want to maybe try to target something like, okay, it's 24%. Let me target that first, and then I can chip away at the smaller debt. So it's really a matter of choices and really what's going to be what works best for you and your financial goals. So the reason you want to, when we try to pay off those debt and kind of chip away at it, it's if you have any extra money, if you have a side hustle, for example, babysitting, or if you are a good writer and you're helping to like proofread people's papers, or you're tutoring, those extra little money that you have, you can put it in towards your emergency fund, as well as trying to chip away at that monthly bill, like pay a little bit extra, because that little extra is going to also help you kind of achieve the goal that you want, that you just wrote down on your paper. So for example, you pay $225 and your interest rate is a little bit less, and you can pay more, and then of course it also makes the time that you have to pay it back less. Again, if you pay like an extra, just that extra $25, $250, that same $10,000 loan at 7%, the interest rate is lower. It's 14.21, and the amount of time that you have to pay it back is less as well.
Yeah, and this is always a good one. I always like this slide because it just shows the little impacts. And we know that going from $200 to maybe $250, that's a significant amount, $50 to increase. So one of the tips that we have is, even if it's $10 a month, just put it on your calendar, put a calendar reminder to just see, okay, what if I pay that extra $10 a month? How much money is that going to save me in interest paid? Or, as Dominique had mentioned earlier, the total cost of that debt. And if you're not necessarily motivated by the, okay, I'm only going to save $200, then look at the terms or look at the time that you're going to be able to save. If we go back to that financial goal that you had, if you are trying to, and I'll use Dominique's example for consistency, but if you are trying to save for a new car and you're able to pay off the current debt that you have and have those funds available 8 months earlier, that could be a motivating factor for some of us. So, find whatever works best for you. If you're more motivated by the dollar amount and how much money you're going to save, then, focus on that. If you prefer to save, to think more of the time and just be, one of those people that's just like, oh, I just want to be done with it, then focus on the terms. And, I'm going to sort of keep us going with a couple of other tips that we have. I did see that a couple of questions have come in. So I think I'll just take a quick moment to address some of these questions. One of the questions that came in, when we say loan, are you including credit card debt, loans? Yes. So for our examples, and thank you for asking this, for our examples, we try to keep it as simple as possible. So we just say $10,000, but it could be, credit card debt, it could be loan, it could be a combination. It's more for the concept, and that's something that we always try to focus more on the concept, because we know everyone's situation is different. And what, for some of us, it may be a combination. It may be credit card, student loan, and debt, and personal loans as well. So it could be a combination of debt. So we just try to keep it simple, and we just say $10,000 in loans. But again, it could be a combination. The key points here are really to lay out what those debts are. We know that's not a fun exercise to have to write out the debt that we owe, and what's the interest rate and how much is it going to cost me. But hopefully by then knowing the cost of the debt, that can then help you understand how much money you could potentially be saving. And if we tie it back to our goal, how much money we could be saving to then apply to the goal, to the why. Another question that came in, is it better to focus on paying off debt or saving some money in an emergency fund savings account? Thank you. Another great question. So I was going to talk a little about that later, but I think this is a perfect time. As we're thinking about debt repayment, a lot of times, I know, feel free to put it in the chat, or sorry, in the questions if this has ever happened to you. But a lot of times, I know when I've been trying to pay off debt, something happens and then I have to charge my credit card for something. And, it can feel a little bit discouraging, truthfully. It's like, oh, I've been doing so good, and now I have additional debt that I didn't plan for. So emergency funds is a big part of the debt repayment strategy. So we recommend making sure that you have some funds put aside towards emergency fund. And, the financial experts recommend 3 to 6 months of expenses, but I don't know about you, that's a lot of money for me to think of 3 to 6 months of expenses. And that could be overwhelming and really discouraging to even want to start to save that much money. So even if it's $500 or if it's, $1,000, starting with something in an emergency fund, which should be in a separate account so that you're not tempted to utilize it for something else. You really want to try to put some money aside. And, someone made a good point. How can you do that when most people live paycheck to paycheck? Exactly. It's very hard to save 3 to 6 months of expenses. I'm here with you. I completely agree. So that's why we say try to start with something small. Try to start with $500, $100, having something is still going to be better than having nothing. And even if it does take time, which for most of us, it has to take time, because exactly, the costs are extremely high, especially with inflation right now, putting some money aside. So what does that mean for the debt repayment strategy? Well, if I am trying to pay off my debt and I am making my budget so tight that I don't have that extra space to save towards emergency fund, then I would relook at that budget and I would put some money aside, even if it means that you're going to take longer to pay off the debt. How this could It's going to benefit you in the future, because when something happens, because it's always going to happen, life happens. When something happens, then you have the emergency funds to lean on and don't have to then take on additional debt. And the other benefit of putting money aside is if you get to a point where your emergency fund feels extremely comfortable for you in the, whatever that means, we're all different and have different financial situations. So whatever that means for you, and maybe you have a couple of credit card payments left to be done and could potentially take from the emergency fund to pay it off, that could be a potential option. Again, it depends how much money you have that you want to have to feel comfortable. So that could be a potential option in the future. So it's never too bad to save that money, because it'll give you more options. And I do want to remind folks, through PeopleSoft, we have the option of putting money into our savings accounts. Well, we have the option of putting our paycheck into multiple accounts, including if you wanted to have one into savings, and you could do percentages. I saw that someone commented that they do that. I also do that as well. So what we do is we put a percentage of our paycheck that goes into a savings account through PeopleSoft. So you can go in, if you haven't done that, it's something I recommend. Just go in, set up a separate savings account that is just for savings, and you could put a percentage. You could do 1%, 2%, you could do $50, $25, whatever works in your budget. And if you need or want some sort of help trying to figure out, well, how do I find that money to put aside? I'm already living on a tight budget. The booklet that Dominique shared earlier, which I will put the link in the chat right now, you can get it off of our Thrive page. From Thrive, you go to workbooks. It's aligning your priorities. That can help you find some potential ways to find money to put in a savings account or reduce some expenses. Another option, also through Thrive page that I put in the chat, you can contact GreenPath Financial Wellness, and they are accredited credit counselors. They also do budget counseling, and they can help you. You can give them a call, tell them that we referred you at HUCU, and they can actually walk you through your budget. They can see what potential resources are available to help reduce some of your expenses. So that is another option. Thank you so much for these questions. A lot of wonderful questions that have been coming in here, and I will keep going. But if you do have any other questions, please continue to submit them, and we will make sure to answer those for you. This presentation is for you. We're here to help you. So if there's anything we can do, please let us know. Okay, so now that we have an understanding of what is our goal, like why are we trying to pay off this debt? Yes, we want to pay it off because it's great to not have debt, but what's the good, like the extra top cherry on top, if you will? What are we trying to purchase? So for Dominique mentioned a car. I saw someone put in home expense. Someone's trying to save for home expenses. So now that we have an understanding of the why, what's motivating us to pay off this debt, and that we understand how much we owe and what's that debt costing us, then we're going to take a look at what are our options. So I know what I'm trying to do. I know how much I owe. Where do I go from here? So there are a couple of things that you have as options. And one of them that, sometimes we don't really talk about is talking with your lender, just reaching out to them first to see what options you have with that specific lender. This is very common, especially if you have credit card debt. So if you do have credit card debt and that interest rate is no longer the promotional rate, so it's no longer that 0% rate that they usually give for the first year, sometimes a little bit longer. And with credit cards, the interest rates can be pretty high. They can be, we have some credit card companies that have 20s, especially if it's a store card or a credit card that's specific to a website. Those sometimes are 20, 25%. So if you have a higher rate credit card or any other debt that's out there, it could be loans as well, contact the auto loans as well, contact the lender and see what options are available to you. See if they have either rate reduction or are there deferment options. If you're in a situation that you can't make payment, what if you do they have different payment options? And just speak with them. Make sure, as always, when we call anywhere, keep notes. I know this recently having to call the doctor's office and then having to talk to multiple people. They're like, oh, who did you talk to? So always make sure you keep notes, who you spoke with, and just see what options they have. The reason that it's good to see what options your lender has is sometimes that may be the easiest solution is just call the lender, explain your situation. They may be able to reduce your interest. That means that more of your payment goes towards the principal, and that means you could be paid off sooner. There are going to be some situations though that may not work. Talking with the lender they may come back to you and say there's nothing we can do. But that is a good place to be for you, because then you know, okay, I tried that option, didn't work. Now I'm going to see what other options I have available. And for some of us, that may mean refinancing our debt. So what exactly is refinancing? I know that for some of you, you've probably done this, you know what this is, but we always want to make sure we're all on the same page when it comes to these, because we all have different financial backgrounds. So for those that maybe haven't done a refinancing, what it is when you take the debt that you have with company A and you go to another company, you go to company B with that loan. So for example, I may have a $10,000 loan with company A at 10%, but company B is offering a 5% loan. So I could go to company B, apply for that $10,000 loan, and now pay 5%. Company B pays off company A. I am done with company A, and now I pay company B the same amount, that $10,000, at a lower rate, 5%. So that is why most people will refinance. It's a lower interest rate, and that is the main reason that most people do it. There are some times, and this is, goes back to one of the comments that was brought up about living paycheck to paycheck and having a tight cash flow. Some people may refinance because the lower interest rate could also allow them to have lower monthly payments. So for some people, they may choose to take that lower monthly payment to allow more space in their monthly cash flow, to essentially increase their cash flow. Some people, though, may choose to do a refinancing and extend the terms, and that could be an option for some. We're always going to recommend use calculators, compare your cost of the loan, also known as that interest, because there may be times that it may make sense if you're in a financial situation that it's tight right now and you need to have a lower monthly payment. Another way of doing that could be to extend the term. So instead of having a 5-year repayment term, I may go with a 7-year repayment term. So I may do a little bit longer. Depending on the interest rate and the amount that you borrowed, sometimes that cost may be relatively minimal, so that you could choose to do that knowing that's going to cost you a little bit more, just so that you have more flexibility in your month-to-month budget, which could be a big, can have a big impact. Or if you're in a situation that okay, in the next couple of years, I'm going to be paid off with XYZ loan, I'm going to be expecting a promotion or a raise, and you know that your cash flow will increase later, that could be another reason to extend your terms today. And then later, when you have additional income, go to that strategy that Dominique shared earlier. Pay more than that minimum, so you could accelerate the payments later. So that's another reason that sometimes people may refinance, that is not just because of the interest rate. Another piece to be aware, typically with refinancing, there's no prepayment penalty. So if you wanted to accelerate payments in the future, you're not going to be penalized for that. And being a numbers person, I always think it's helpful to just see these things laid out. So here we have an example, $10,000 loan, or if you want to say credit card debt, whichever you prefer, but for our case, we're just going to say loan, so it's a little bit easier, with a $200 payment, so $200 monthly payments for 60 months or 5 years. Loan payments are like babies. It's like months. You don't say years. So it's always terms. Like what are the terms? 60 months, but it's 5 years. So if I have that at 7%, I'm paying about $200. Well, I'm paying $200 a month. My total interest is $1,858. I don't know about you, but usually when you think of interest, especially when it's, interest in a bank, it's money that's paid to you, and it sounds good. It's like, oh, interest, that's good. I want that. And we do. We want to get paid interest. We don't want to pay interest. So I always like to think of total interest paid as the cost of the debt. So it's costing me $1,858 to have this loan for 5 years. But if I'm able to refinance and I'm able to bring down that interest rate, even if it's, down 2%, it is going to save me money. Now, a couple ways that it does that. When you refinance, typically you could keep more or less the same terms or the same the length of the loan, if you will. So if I was already in a 5-year loan, I could refinance maybe for another one that's 5 years. In this example, I'm not saving any time. So if you're motivated by time, this isn't going to be what the motivator is for you necessarily, but I am saving about a little bit over $500 in this example. My monthly payment is going to be lower. It's $11 lower. So for some of us, that may be, it's only $11. Why would I bother doing that? Well, it's because we have to go back to why are we doing this? Why are we trying to pay off this debt? If I am trying to purchase a new car and I could save $500, but that could then go towards my car payment or towards another personal goal that I have, that's $500 that could be used for something else. However, if I was paying $200 to begin with before I refinanced, and then my new amount is lower and I have the cash flow and I was comfortable making that $200 payment, then I can stick to that $200 payment. And this is something to look for when you're putting down the cost of your debt and you're trying to figure out which one am I going to pay off faster? Am I going to use the snowball method? Am I going to go with Avalanche? See how comfortable you are with sort of the payments. And if you are able to, in this case, pay that additional $11 a month, that's going to save you about $100 in total cost. But for those of us that are motivated more by time, that's going to save us 3 months. So we're going to be done with that loan 3 months sooner, 3 months quicker by just paying $11 more a month. And again, I understand that, for some of us that may be doable, for some of us it may not. But the key takeaway here is use our calculators, or if you rather use other calculators, there are many on the online. Bankrate has them. NerdWallet, there's so many out there. We have ours on our Thrive page, which is in the chat. And just play with the numbers and see, well, what if I pay an extra $10? What if I pay an extra $20? The higher the loan rate or the higher the amount that you owe, the more of that impact that it will have, especially if you're at the beginning of repayment stage with a lot of these loans with higher balances. And you may think, oh, $10 is not going to make a difference, or $20 a year. It may, and it may make such a difference that it may be enough to motivate us to maybe reduce another expense. So maybe for some of us that's getting rid of a subscription or finding other ways to cut expenses so that we can accelerate that debt repayment. So I know that there have been a couple of other questions that have come in, so I'll take a quick moment to answer these. Okay, so there was a question that came in if it's something that we can do with credit union and credit card debt at another bank. I don't know what that something is, so if you wouldn't mind just putting a follow-up question just to which piece you are referring to. Oh, refinancing. Thank you. I love this. It's very quick. So yes, refinancing. Yes, we do offer refinancing at the credit union. So we refinance all debt. I'm trying to think what debt we don't. We do have student loan refinancing, which I'll talk about shortly. I know a question came in about that. We refinance auto loans, credit cards, other personal debt, and I'll talk a little bit about examples in the upcoming slides. But yes, we do have that as an option through us at the credit union. And you can learn more on our website or just come into a branch if you'd like. And another question that came in, do you have suggestions on budgeting software, like You Need a Budget, Truebill? It's all personal for some people, and I welcome anyone. If any of you have a budgeting software that you like, please put it in the questions and I'll share it because we can all learn from each other. I know a lot of folks that we work with use Mint. That's another one that you didn't mention, but that folks like. I know for myself personally, I'm an Excel person, so I have a old-fashioned but works really well for me Excel budget. I created my own one, and then I just list all my expenses, something that I do. I keep track of all my expenses and I actually put it in and check, and I do that about once or twice a month. Thank you, everyone's so great putting in their suggestions. Okay, someone said that they use Quicken. Someone says that they use Truebill and really like it. Another person said that Mint is very helpful and gives you updates if your credit score changes. And someone said that they use Excel for weekly budgeting. Thank you so much for putting these in here. And I know that someone mentioned they have to log off. We will be sending an email by the end of the week, if not early next week, with the recording. You can follow us on our YouTube channel, hucu.org/YouTube. Oh, sorry, I said that wrong. YouTube.com/myhucu. And you can subscribe and you'll get a notification when we when we load the presentation there. Someone said that they use Aspire and Google Sheets. So there are some suggestions, and thank you so much, everyone, for sharing those so that we can all learn from each other. Thank you. Okay, so I will keep going. I know there are some other questions, but just keep them in there, and I will take a moment to answer more shortly. There are some things to consider about before refinancing. So refinancing could be a great option for some of us, but it may not make sense for all of us. I very quickly mentioned student loans and how we do offer them at the credit union, student loan refinancing. But if you have federal student loans at the moment, it wouldn't be good to refinance because the federal student loan rates at the moment are at 0%. Someone asked if we know anything about Biden's possible student debt forgiveness. We don't. We know the same as you. It's, it's in the media. Just yesterday, I saw something that he potentially, that the Department of Ed is ready should he cancel them or cancel a portion. I also saw the same day something else about how people should get ready to go back into repayment. So we don't know what's happening. So unfortunately, it's one of those things we'll all find out together, and probably right before whatever it is happens, whether that means extending that 0% interest any further. But it's hard. We just don't know. So if you do have those federal student loans and they're at 0%, my best suggestion right now is be ready to have that payment should you have to make it in the next month. Just be ready, have it ready for you, because it is that, you just have to be ready because we don't know what is going to happen. The other part of that person's question was if we have any info or resources for Harvard. So if for any of you that do have federal student loans, which probably is most of us here, but if you do have those federal student loans, one of the things that you can potentially qualify for is public service loan forgiveness. And as Harvard employees, we are eligible for that, as Harvard is an eligible employer, I should say. There are other pieces that would make you eligible for the program, but you can learn more about student loan forgiveness, and I'm putting in the website now. One moment as I try to multitask. Okay, so I just put the website in the chat, but if you go to studentaid.gov/PSLF, Public Service Loan Forgiveness, or if you do a Google search for Public Service Loan Forgiveness, but make sure you're on the student aid website, you want to go to the source. You can learn more about the program. For Harvard employers, your local HR representative can certify you that you work at Harvard, and you could potentially be eligible to have some of your loans forgiven. If you in the past had applied and it was denied, there is an extension that goes through October of this year. So if you were in a standard repayment instead of an income driven, or if you had some loans that didn't qualify before, you may be eligible now. So you want to make sure there was a special extension, a special waiver that was done, a couple of changes, because the Department of Ed realized that the program had, a lot of glitches, and they decided that, for about a year, they were going to have this extension of exceptions, and that expires in October. So if you ever applied before, or if you ever thought about applying for public service loan forgiveness and decided not to because you didn't qualify, take a look on the website. They have a PSLF calculator, a toolkit that can help you to see if you now could qualify. And if you do, try to get that in by end of September to be safe, because that extension is through October. So a couple other questions in the chat, but I will go to them shortly. Other things to consider before refinancing. We talked about interest rate. As we know, interest rates are going up. So if you have increase of interest rates, it's good and it's bad. It's good in one sense because now savings accounts, certificates of deposits, I know us at the credit union, we recently increased our certificate of deposit rates. So it's a good thing in that sense. Like you're able to increase how much people are getting paid for having money in a financial institution. But as we know, the negative, which impacts probably most of us, is that now the cost of debt is going to be higher. So if you are in a situation that you already had debt that was a little bit higher, it may still be beneficial for you to refinance, which means change who is the holder of your debt so that you have a lower interest rate. It is something that I would recommend researching sooner because it is expected that the rates are going to continue to increase. If you are in an environment, maybe your rate is already at its highest, hopefully, fingers crossed, the federal rates will adjust in the next couple of months or year, and rates will hopefully get reduced for loans in the future. Know that just because you have the current rate that you have now doesn't mean that you have to be stuck with it for the life of the loan. Refinancing is something you should always just keep an eye out. For us on our website, you can just actually go to our website and we have all our rates listed. There's a page. If you go to our website at the bottom of the page, you'll see it, but there's a page that we have all of our rates listed, so you could always see if you kind of want to compare around. But just know that you want to shop around, if you will, for interest rates, and you can do that without applying. You can do that by just looking on a lot of websites, a lot of lenders' websites. Keep in mind before refinancing or considering to refinance that you could lose any benefits that you have that are associated with the original loan. That is why if you have the federal student loans, we don't recommend refinancing them right now, because should President Biden forgive parts of loans, or should the 0% rate be continued, or maybe goes from 0 to 2%? I know maybe it doesn't go back to your full percentage interest rate. You would lose that benefit. It's as if you were renting or living in a home that had an amazing dishwasher, and you now move to a new place. You cannot go back to that old home and use that dishwasher. That's a benefit that you no longer have. So same thing with federal student loans or any other loan that you have. Once you refinance it, those benefits that you originally had no longer apply to you. There may be new benefits, hopefully, that your lender offers, but those old ones you cannot go back to. And then credit score is important as well. Dominique spoke about this at the beginning of knowing where we are. If I know that my credit score is, sort of on the board, like between maybe it's a 690 or 680, and I'm trying to get a little bit over that 700, I may be better off working to improve my credit score before trying to refinance, because it may have an impact on the rate that I'm eligible for. That is, if that lender has rates that are based off of what your credit score is. Some lenders, like us at the credit union, once you qualify. So we actually don't have tiered blending for some of our products. So for our mortgages, for our personal loans, our auto loans, once you qualify, everyone gets the same rate. Other lenders may be a little bit different. So you want to check with your lender. And if you're not sure what your credit score is, there are a couple of things I would recommend, and these are all free. First, check with your financial institution. Check not on the app, but actually on the desktop version, because many times you have your credit score that's available to you, but you may need to authorize access to it through your desktop before it is added to the mobile app. So, you obviously, check through the mobile app. Maybe it's already there, but if you don't see it there, it doesn't mean that they don't offer it. It may mean that it's just not approved or not linked to your account. I know for credit union members, we do offer your credit score. You should be able to get it on the app or on the mobile, or on the desktop version. Another option that you have is there are certain certain apps that will provide your credit score. They do provide it for free, but they're usually selling your information. Nothing's truly ever free, unfortunately. There's someone's paying for it in the back end, or there's something that some other benefit that someone's getting out of giving you this information. So for those apps that do provide the free credit scores, they usually are selling your information, which means you may get more credit card offers, you may be getting more loan offers. So that's something to be mindful of. But first check with your financial institution or your credit card company, because they typically will offer you your credit score for free. It's something that they have access to, and it's a very common practice now for them to offer that to you. If you aren't sure if there's minor tweaks that you can do to bring up your credit score, contact GreenPath. That is a free service, and I'll disclose it. It's free for you because we pay for it. So as a not-for-profit, we want everyone to be financially well, so we pay for it so that you don't have to. So you don't have to worry about them selling anything to you. Why it's free to you is because we are taking care of that for you. But if you contact GreenPath Financial Wellness, they are free. They offer free credit counseling, so they can actually go through your credit report. They won't be able to provide you the credit score for free because they don't get it for free. If you go to annualcreditreport.com, unfortunately, that is something that's not provided as part of the credit report for free. So you would have to pay for it. But first check with your financial institution, because many, many times they will provide that credit score for free for you. So this is, I know I sort of talked a little bit about these, but these are where we're thinking about if you do have the debt that you are in a interest rate that you don't want, that's a little bit higher, or let's say you have a debt like credit cards. Like credit card debt is challenging because with credit card debt, we have to pay it off in full by the end of the month. And that's where it gets really complicated and tricky, because if I owe $3,000 or $4,000, then how am I going to be able to pay that off in a month to avoid interest? Like that gets to be really challenging. So a lot of times what people will do, another option that you have is take that debt that you have and you can go with a personal loan or a debt consolidation loan. So what these are loans that you can go to your financial institution, you can come to us at the credit union, and you can apply for, I'm going to make up numbers just for example, but I could apply for a $5,000 debt consolidation loan because I have maybe $3,000 in credit card debt and $2,000 that I owe on another credit card, so $5,000 together. If I go and apply for a debt consolidation loan, what that debt consolidation loan does is my lender, or in our case, if you apply with the credit union, we would pay those two credit cards for you. We'd pay them off so that take that $5,000, we pay them off, and now you will owe us the $5,000. Now, the reason that the debt consolidation loans tend to be a better option than, especially for credit cards, the reason that they tend to be a better option is that with credit card debt, you have that month. With a debt consolidation loan, you typically have 5 years, or sometimes you have 7 years, depending on the lender or the loan that you go with, to pay that off. And the rate is substantially lower. Dominique, if you wouldn't mind, I apologize, I don't remember exactly what our current debt consolidation loan rate is, but if you wouldn't mind just checking on our website and then just letting us know when you get that. But let's say that your credit card loan, your credit cards are at 18% or 5%, not 5%, that's usually another case, but 18 or 20%. With the debt consolidation loan, it's significantly lower. So it helps that you no longer have to pay that full $5,000 in a month to avoid interest. You can now spread that over in about 5 years or 7, depending. With the debt consolidation loan, it sort of depends. With some companies, they will make you close those credit cards that you have with them, because now they want to make sure that you're not taking on additional debt with those credit cards. There's some lenders that will maybe allow you to keep a credit card open. And a lot of times this is where these conversations and this planning has to really take into place, because closing a credit card does sound bad. It's like, oh, I'm closing a credit card, I don't have access to that credit, I can't use that credit card. And that definitely does sound like a negative. For some of us, that may be a positive though. If I have this credit card and I am trying to pay it off, that may be something that I am better off by, okay, now I can't use it. So now the money's gonna go to this lender, I'm gonna be able to pay this off first. I'll be able to have more of a strategy towards it. So there are situations that would make sense. There are situations that wouldn't. GreenPath is another great resource. They do debt counseling, and they can help with it, with what strategy may make the most sense for you. A couple of other things, I already talked about these, but you could also refinance mortgages, auto loans, student loans, but mortgage rates unfortunately aren't going up. Right now, HELOC rates are pretty low still. Mortgage rates themselves, though, have gone up. Auto rates, most of these have started to go up. So if you're in a situation that you think you might want to refinance, definitely want to take a look at those rates. Other piece here, the credit card balance transfer. So I always like to talk about this because we get a lot of offers for these in the mail, or you may hear a lot about these. Credit card balance transfer is when you, same as refinancing, it's just a different way of saying it, but I could have debt that I owe credit card company A. Maybe I owe them $10,000 at 10%, same example, but I could go to credit card B is saying, well, if you transfer that money over, you were going to charge you 0% for a year. Now, the benefit in that is that I'm not being charged interest, so I no longer have to pay that 10%. That could work really well for some of us. However, in order for that to be a successful strategy, what we recommend is calculate what the monthly payment would be each month, set that up with auto payment, so that if I need to pay, and I'm making up numbers, this doesn't have to do with the last example, but just for easy math, if I have to pay $300 a month to be able to pay that credit card off in a year, then I want to set up those auto payments for $300, and I actually don't even want to use that credit card. This is similar concept to closing the card, except that you're not closing this card because it's a new one that you have. Just don't use it, put it away, or maybe charge one thing a month, like a subscription or something that's automatic, that's low amount that you already are utilizing, so that you get the credit utilization. And the key to that is you don't want to add additional debt, because if the strategy is I want to pay this off in a year while that interest rate is 0, the focus should be on paying that card and not adding on additional debt. Where a lot of us unfortunately don't succeed with credit card balance transfers, it's that with credit card balance transfers, many times we see that 0% and we charge more. So that $10,000 or $5,000 that I transferred now turns to $7,000, and now I have to pay interest on that. Another piece to be mindful is that interest rate is 0%, but there is a balance transfer fee. So I am going to be charged something for just having that credit card. It's not okay, just going to give you 0%. They will charge you, usually it's 3% or 5% of your total balance to bring that credit balance over. So that's something else to be mindful of. Dominique, I just wanted to check in, see if you were able to get those rates.
I did. I wanted to make sure you were finished speaking. So our rate right now is 5.99%. You can borrow up to $25,000 for up to 60 months.
Thank you, Dominique.
You're welcome.
And that's a really, take a look at that. Check other websites. We always recommend, we're here to help you and we want you to do the best. So check other websites too and just compare if you are thinking about those. But, that 5.99 is significantly lower than most credit card rates. And because you have that 5-year term or 60 months, it gives you more flexibility in month-to-month cash flow. And you could always pay it off sooner. So if you are able to, that is a good alternative. A couple of other questions that came in. Is there a link to register to become a member of the Harvard Credit Union? Yeah, you can actually just go on our website. So I'll just put that in the chat. You can go to hucu.org/join and you can learn more about becoming a member. Another question that came in, can the credit union act as a guarantor when apartment hunting? Laura, I don't know if you want to speak to, I don't know if the housing loan helps with this, but I don't think we technically are a guarantor for apartment hunting, but I don't know if there's.
Yeah, thanks, Medalia. So the HUCTW does have a rental transition loan. That loan does not work as a guarantor, but can provide up to $3,500 to help with first, last, and security. But I'm not aware of any program at the university that can provide that piece of the puzzle.
Thank you. Yeah, same here. I haven't heard of that. But hopefully the 3,500 can help though. And you can learn more about that on HUCTW's website. And then one other option that we wanted to share is, there are many different options, and we know that we went through a lot. So for some of us, yes, paying a little bit more each month can help us. For some of us, being able to refinance may be an option. But for some of us, that may it's hard. It's expensive time to live, and we just may not have the resources, and being able to look for an additional side jobs may not be doable, or we may not be eligible for a promotion or a raise at the moment. So we realize it's hard. There are still other options. Another option is a debt management plan. Now, this is for those of us that are in a situation where our monthly payments are just mostly going towards interest, and everything that we discussed today can't essentially help your situation because there's just no cash flow there. So this could be another option. A debt management plan, what it does is it reduces the interest rates that you owe on your credit card. You work with a third party. In our case, we work with GreenPath. They offer the service to our community. And GreenPath works as the middle person or the middle entity that will work with you to create a budget that works for you. They'll work with the creditors or the lenders to reduce your interest rates. You have an amount that you come up with GreenPath based off your budget. Let's say $400 a month. This is what Migdalia has that can go towards her debt. GreenPath, you then have that $400 automatically taken from your checking or savings account. GreenPath then pays off your debt on your behalf. There is a monthly charge, $10 per account per month, up to $75 in the state of Mass, meaning that if I have 8 accounts, it would not be $80, it would still be $75. This is a plan. It's regulated by the federal government. You have budget counseling. They do have to close your accounts. This is a good option for a lot of our members. We have, I think it's close to $500,000 of debt that our membership has in these debt management plans, and they've actually paid more than that. So I think our members have paid over $500,000 on these plans. And it's not a quick fix, but the key here is you have a counselor that you're working with. It's not debt settlement. If I owe $10,000, I'm paying $10,000 off. Here's an example of an actual member's debt management plan journey. Originally, they were paying $573 a month that was going just towards interest. So their actual monthly payment was about, $620, but $650. But it was mostly going towards interest. And I know this has happened to me. This is where it gets so frustrating. When you're trying to pay off debt and you're sending them money every month, but you don't see that principal going down. This is one of those situations. So what they did is they put their debt in a debt management plan with GreenPath. So now, if you see at the bottom, the principal payment, before only $75 was going towards principal. All that $573, that's the cost of their debt. That is just the interest. And that's a lot of interest. That's a lot of money. So on the debt management plan, GreenPath was able to reduce their interest rate. So it made it so now $484 is going towards the principal, and that total interest charge has been reduced by over $300. As I said, there is a cost for the plan. So in this case, it was $50. But as you can see in this example, that cost, yes, I'm paying $50, but the savings of how much money is actually going towards my principal is worth it. So this is something, if you think it may be of interest to you, take a look on the GreenPath website. It's not for everyone, but we do want to recommend, learn more about it. This session today and this conversation is about knowing your options. And next steps are really for you to decide what makes sense given your situation. So I know we went through a lot, so staying motivated is really important, writing down those debts that you have, being informed, and then take action. Not taking an action is an action. So if you do nothing else, you'll be in the same situation. But if you take another action, whether that's contacting your credit card company, see if they can reduce the interest rate, or looking around to see what the different rates are for maybe a debt consolidation loan, or maybe it's a different product that can help you. It's all about staying informed. We do have a quick survey that we'll ask for you to complete. I will put that in the chat right now. But as I'm putting this information, please let any other questions that you have, please put those in the chat, or excuse me, in the questions panel. If you have questions for myself or for Laura, so if you have any HUCTW specific questions, please let us know. And please do take the survey. We meet with Laura and with Danielle a couple times a year, and we go through all the survey feedback. It helps us improve the topics. It helps us improve the presentation. So we really rely on you for your feedback. So it's a quick moment, but it makes a huge difference. I do have to provide a little bit of a disclaimer. I said this at the beginning, and I know Dominique said it as well. These are all examples. We don't know your specific situation, so we ask for you to contact GreenPath. I know someone asked for the link for credit counseling. If you go to our website, hucu.org, and then /green as in the color, path as in PATH, you can contact them for credit counseling directly. And a couple of other questions that came in, Laura, one of them is for you. What was the name of the loan again for housing and rent?
Oh, sure. So the loan I was talking about is called a rental transition loan. We also have other ways to help save money for our membership. So something to be mindful of, you can't plan for everything, especially things that happen with your home. So we do have an emergency loan for home expenses, like if your water heater breaks or you find yourself in a situation that was completely unexpected. We can definitely help with that. We help with commuter costs for people who live further out, which I know is becoming more and more common because of the expense of living in the city. And we have help with childcare and education. So if you find yourself needing any of these things, or you just want to learn more about them, you can either go to our website or reach out to your organizer if you know who they are, or reach out to me, and we'd be happy to answer any questions. But the more money we can get into your pockets, the better. So don't be shy about asking.
Thank you, Laura. Someone else asked, what happens if you have 60-month loan, a debt consolidation loan, and something comes up and you can't pay it within that time frame? I would check with the lender. I know that, especially for us at the credit union, we're here to help our members. We exist for the well-being of our members, and we would usually, we would work with our lender, our member. But check with your lender, because most lenders would hopefully assist you with that. Okay. So another question that came in, if it's 0%, but doesn't it make a difference with your credit report? I think this is about student loans potentially. With student loans, they are being reported as not making a payment. I don't know the exact details, but I do believe that the credit bureaus had made some adjustments. So unfortunately, I don't know the full extent right now. But I would check, I think you can check on student aid. I think they have the information there listed, but unfortunately, I don't know the details on that specific one. I don't see any other questions, so I just want to thank you again and just remind you that the presentation will be on our YouTube channel. You can go follow us on My HUCU on YouTube and on all other social media platforms. And if there is anything that we can help with in the future, please feel free to reach out. You are all eligible to become members of the credit union and have access even after you're no longer a Harvard employee. And once you're a member, your family members are also eligible. So if someone else that could benefit from any of the resources that we offer could extend to them. That's all that I have this time. I'll turn it over to you, Laura, in case there's anything else that you have, but thank you so much, everyone, for joining us.
Thanks, Migdalia. I just want to say thank you again to Dominique and Migdalia from the credit union for working with us to create learning experiences for our membership around finance, which we know is extremely stressful right now. I did put a link to the rental transition loan in the chat, and I'll also put a link to our website. So if you don't know who to contact and who you work with in your department, you can reach out to our info account and get that information. And I just want to sort of reiterate that we all have a variety of experiences, and I'm glad that you were all able to come and get some advice, but we also know that you don't always want to talk about your experiences around money in public, so don't hesitate to reach out to us with any questions or concerns.
Thank you, Laura. Thank you, everyone. Have a wonderful afternoon.